Uh, Looks like everyone's kind of trickling in. Probably some people join in the middle a little bit. I want to just make a few introductions. So most of you know me, so thanks for joining. You know Weiss. Normally, I spend my time doing cost segregation, but started this whole virtual meetup basically as a product of this quarantine. But I think we're going to continue it. I got a whole amazing group of speakers this week and lined up over the next couple of months. So I hope you enjoy it. Different topics. I'm definitely open to suggestions. If someone has a suggestion of a topic they want to cover or have a great speaker that they want to come in, love to have that. And tonight is really, the stage is all of ours, because I really want this to be a little bit of a discussion. Obviously, Ben and Sam are here, and they're going to share with us some great information about how they see the market, what they're doing, how to guide things. But I think we'd love to open this up to questions as much as possible, and keep this as a dialogue. And as questions come in the chat box, or as people trickling in, I'll try to field those, and we can keep it going. So, before we do any of that, I just want to say a big thanks, appreciation to Ben and Sam for coming out, taking the time out to busy schedules, and for all of you taking your time out tonight to join us. And we're gonna hopefully be doing, like I said, doing this every week, 7 o'clock Wednesday. Feel free to join anytime and put in your questions in the chat box if you have it. Ben and Sam, just a little bit of an introduction. They don't need any introduction, but if you've ever been to Bigger Pockets, you probably know who Ben Leibovich is. If you've ever heard of that website, it's a great place to find basically anything you want to know about real estate investing. So I highly recommend, if you're not active on Bigger Pockets, it's a great way to learn about real estate in general, and to come across amazing people like these guys. A little bit of background: Sam and Ben got together a few years ago and founded Whitehaven Capital, which is a private equity investment firm. They're buying multifamily properties in the Phoenix. Specifically, they've targeted Phoenix MSA as their hub. And maybe they'll talk a little bit more about why they chose Phoenix and why they're so bullish on Phoenix. Over the past couple of years, they have over just under $50 million of assets under management, and they've definitely done a tremendous job in repositioning a lot of these underperforming assets through kind of the methods that they have, which are not entirely unique, but I think how they operate their properties is something that not a lot of the mainstream syndicators are doing in the same way. So, without further ado, I'd love, maybe Ben and Sam, well, obviously Ben, because Sam is not going to talk as much probably. Is Ben still here? Did he get bumped off? Oh, there you are. It's like, the Brady Bunch over here, everyone's like moving around.
I did get knocked off, and Sam is still there, and it's funny enough, I'm gonna go into a different space because I'm thinking maybe I'm too far from my router or something. My connection is.
So do I have a better internet connection?
Funny enough, you might have better connection. It's unbelievable that he can be on the plane 20,000 miles up in the air, 25,000 feet in the air, and have a better connection. This should be better. But, Yona, I'm outside, yeah. So if you might hear some background, but this is the best. This is the best I can do. Otherwise, it's gonna keep dropping me. Anyhow, Sam, do you want to take it, or do you want me to take it?
Go for it.
Well, we buy apartments in Phoenix. We like Phoenix market, like Yona mentioned. We like it because of the fundamentals. We think, Warren Buffett says diversification is protection against ignorance. We think in real estate, growth is protection against everything. If you have population growth, you have job growth, you have scarcity of a particular asset class, you have structural imbalances. For instance, construction costs are prohibitive to building a particular class of asset. If you have those things in place, then chances are better than not that you will be okay. We talk about succeeding and we talk about creating value. The most important thing is not to lose value. And so those kinds of things I'm describing, that's really aimed at trying to not lose, first and foremost. I could talk for hours about you. We do have a very specific way of looking at multifamily value add. We buy a very specific product. We buy it with a very specific business plan. But I don't necessarily want to make this about us. I really would like for us to discuss, if anybody has questions, specific questions, points for discussion. I'm happy to continue talking about our stuff. We're pretty excited about our stuff. I mean, we have discovered a model that we think is uncommon and works better than the average. But I don't want to monopolize this conversation. So I want to hand it over to Yona, and whatever way you guys want to do this. I just don't want to take it upon myself to keep talking, because I could. I could.
Well, the best part about
I've never seen Ben actually hand over the mic.
Yeah, I was going to say the same thing. But with all due respect, the best part about these meetups, I think, and everyone will agree, is is after whatever that point is, we actually go into breakout rooms with this cool Zoom feature, and we'll split off into groups of 3 or 4, and then just do continued conversation and networking that way. And so at any point, I just may choose to take it at that point. But I think it's a perfect time. If anyone has any questions, I think the focus of tonight, we really want to talk specifically about multifamily in the times that we're in right now. COVID, obviously there's been a tremendous, amount of things happening, so many moving parts that we don't really know what's going to happen. We don't know what's happening all around, but we're all waiting to see. So I'd love to hear your takes on it. Everyone takes on it, some strategies, maybe some things we should be thinking about that we weren't. And I'd love to share some things we spoke about last week when we had Iris Lodowitz from President of the Eastern Union touched on a few points as well that I think are appropriate to share again tonight.
Sam, you want to take this, because since you're on the plane, if we lose you, I want to make sure that you state your case before we lose you. So do you want to kick us off?
Yeah, sorry, I was reading a question that I got on the chat. So what was the question?
COVID, how we see COVID playing out, what are the changes,
All right, so actually, this is a question related to that. So the thought was from Jerome. What are your thoughts on buying now versus waiting 6 to 9 months from now? So Jerome, there's a lot of uncertainty. So it's actually kind of put the market on pause. So sellers think that they should still get what they were getting 3 months ago. Buyers think they should have a 10, 15, 20% discount, which nobody can really define. So there's not a whole lot of transactions going on. I'm of the belief that I'm always buying. As long as I'm buying smart, I'm going to have either cash flow and or reserves, and I can withstand a downturn. I don't want to try to time the market. You could see stimulus for the next year, and then it takes another 6 to 9 months for you start to see discounts. So 6 to 9 months, you might not be even better off. So I'm just of the mind of always buying right and continually buying, and don't try to time the market. I mean, people started stopping buying in 2014, thinking we might be at a peak again. And then 2016, the same thing. But those people that bought in 2014 were exiting at huge profits, and that's just been happening every 2 years for 6 years now. And I'm just, as long as you're doing it right, not overpaying, and come in with plenty of reserves. And we can talk about what Ben and I do for reserves. It's about a year's worth of debt service that we have in reserves. And that can cover a lot of things. And that's actually helped us continue buying right now with Fannie and Freddie implementing their 9-month to 12-month year of reserves, that impact us a whole lot in our underwriting. So we're still buyers.
I guess my follow on to that is like, how do we know what cap rates are now? Because the transaction volume has slowed down so dramatically. It's just a question of, where are we?
Right. Well, the thing is, we're not cap rate buyers, because that takes us into a different conversation. It is a cap rate. A cap rate is a metric that evaluates how much other people are buying property for relative to the income in place in those properties at the time they are purchased. I don't really care what other people are doing. I'm not underwriting to the cap rate. I'm underwriting to my returns, which is a function of a lot of different moving parts, but cap rate has nothing to do with it. The only aspect of cap rate that it's a concern to me is the exit. But if I'm timing my exit and giving myself up to 7 or 10 years to get out, then it's easy enough to discount the cap rate enough so that you've bought yourself enough time to time an exit whereby, the cap rate is sufficient in the marketplace.
Ben,
So
I agree with you on the entry cap rate not mattering as much, but the issue that I see is sizing the loan and getting your appraisal to hit. They are playing games with those numbers, but I agree from an underwriting standpoint, it doesn't matter on the entry, especially if there's a value add deal.
well, I agree, and that's where you have to go into the stronger markets. Because if you're going into a market like Phoenix, like, Austin, like some places in Florida, like Atlanta, Georgia, if you're going to places that are driving this economy, they were driving it before COVID and they will be driving it after COVID, then there's a baseline for that cap rate. And you know what it's going to be. So if you underwrite it accordingly and you give it enough discount, then you can know where you need to be right now in terms of sizing your loan and everything else. That's just my 2 cents. I'm just not. We just spoke. 20 minutes before getting on this call, I received an email from our Berkadia guys. They're shopping a loan for us right now, and all of the terms are flexible. Everything. They're looking at everything on a deal-by-deal basis. So it's very difficult in this environment to paint with broad strokes. It's probably almost impossible. But it's, it is what it is. I think it's still possible to underwrite conservatively. I don't know that you are underwriting anything over 65% LTV right now, no matter which way you slice it. And in order to do that, you're going to have an awful lot of value add in your deal. That's the only way you're going to make a 65% LTV loan work on your IRR side of things. So nothing's changed. You needed to have a great deal yesterday. You need to have a great deal today. You may have to raise more money today because bridge lenders are on the sideline by and large, although I've received a couple of quotes on deals we ended up not going through with, but there are some bridge lenders out there still, but majority of them are on the sidelines. So you're talking Freddie Mac and Fannie Mae, and they're going to be, their debt service coverage is the limiting factor. It's not the LTV, it's the DSCR. And if you are buying a stabilized property, you're not going to be able to underwrite the IRR. And if you're buying a value add property, you're going to need some real value add in order to compensate for that 65% LTV. But if you have all of the right pieces in the deal, you can still structure the deal. It just needs to be a good deal. So nothing is really.
What about the vacancy rate? Are you seeing, maybe you can speak about specifically
I'm
your
not
assets.
seeing any vacancy. There's not going to be any vacancy because people are afraid to move, for one thing. For the other thing, they're getting paid to stay where they are. retention is going to be sky high for the foreseeable future. But we're not seeing any issues with retention. We're not seeing any issues with collections. In the less stabilized properties, yes. But in more stabilized properties, and this goes to our business plan, in the more stabilized properties, they're doing extremely well. Not just very well, but extremely well.
Can you give me an
So
example
if
of what
it's
you mean by
something
that,
we
Ben?
bought, huh?
Just give an example of what you mean by that, that the state-wise properties are doing extremely well. Like, what does that mean in terms of
What
dollars?
we do is we buy property where we lift income by about $300 to $400 per unit. So these are very significant repositioning projects. So in properties where we've completed all of the community renovations and we've completed at least 50% of the units have been renovated, those properties are operating at 98% occupancy, and their collections are between 97 and 105% relative to March numbers before COVID hit. The properties that we've had for 3 to 6 months, where we've not had the opportunity, the time to make a significant impact to the CapEx, to the business plan, where maybe we've placed 30 units out of 160, 20%, 25% of the building has been released at higher rates. That's where true Class C tenants that we bought when we purchased the property, that's where we're seeing occupancy dips and collection dips. Having said that, even those are 90% plus on collections relative to March. So not the end of the world, not an environment in which you can't maneuver, and certainly not an environment in which I would stop the renovations.
I think Jerome's asking over here, and I see there's a bunch of questions in the chat. I'll try to go through one by one, but just in terms of something you just touched on now, go a little out of order, that Jerome asked, how exactly are you holding occupancy and moving rents that much? And I think you touched on the point, the fact that you're doing such heavy lifts, heavy value add of the properties.
Right. Well, that goes to the core of two things. Number one, market. Number two, strategy. So Phoenix market, there's a tremendous imbalance between demand and supply in the Class C housing, workforce housing. There was a study done at the end of 2019. I want to say it was Colliers that did the study, and they said that if every apartment complex that had been permitted would be constructed, Phoenix by 2020 would still be short 30,000 units. So there's just, for the population growth that Phoenix has been experiencing, there's just simply a supply imbalance for that. Having said that, in Phoenix, there's really no such thing as physical vacancy. So most of your value add projects, you go into Atlanta, you go into Texas, you go into, vast majority of the country, you're going to find a mom and pop owner with 17% vacancy. And what you're going to do is you're going to bring that vacancy up to market, which is 5 or 6%. You're going to do what I call put lipstick on the pig. And drive rents maybe $75, maybe $100, and call that a day. That is your value add. In Phoenix, because there's such a supply issue, and it is so intrinsic and built in, because you can't afford to build that type of housing. You can't afford to build it and rent it out for $1,000 plus or minus. So all of the new construction, whatever new construction there is, goes to the higher priced Class A units, but that doesn't help Class C anything at all. So with that being said, in Phoenix, unless it's really an obsolescent property where there's some structural issues with the property of some sort, like it's not livable. Like it's got a old boiler chiller system that totally in 115-degree weather 4 months out of the year, you're going to be living in 100 degrees because it just can't lower the temperature enough. Okay, in properties like that, maybe you will see some vacancy. But anything that's reasonably okay structurally and run professionally, you really don't have vacancy. So in Phoenix, you got to do something else for value add. There's no such thing as, hey, here's a property with 15% vacancy. We're going to fix the vacancy, and that's our value add because we don't have any vacancies. It's not, you can't do that. Value add doesn't exist. So you have to do something else. So what we do essentially is we create a subclass. We take a Class C property, we put in Class A finishing surfaces, and we create an asset class that's not quite Class B, but it's definitely not Class C. So we go into an area and we'll look at that 2-mile radius and we say, hey guys, this isn't for everybody. And this is going to be a couple of $100 more than anything else out here. But we need 100 of you. We need 150 of you. We need, whatever. Okay? Are there enough of you that are willing to spend a few $100 more to have virtually Class A finishing surfaces, but for the price that's competitive with the Class B product? So we end up being the Class A of that, call it Class C space. And what happens is when you live on that side of the tracks and you've pulled yourself up by the bootstraps for yourself and for your kids, and you are finally in an apartment with granite and stainless and everything works like it should and it's nicely done and there's an amenity created and the office looks good and there's a gym that we've built and everything else. You finally have that. You don't want to let that go. And there's nothing else available that's like us. And there was nothing available because nobody else has done it. Why? Because we're the only stupid idiots who will go into that kind of location and build that kind of product. So there's no comp for it. There's nowhere they can go. We're it. They can get it, and frankly, they can afford it to drive for 30 minutes and be in Gilbert, in Chandler, in Tempe. But, hey, my kid goes to school here. I grew up here. My grandparents live around the corner. This is where I know people. This is what I want. But I make $50,000 a year for me and my wife. We can afford $1,000, $1,200 rent. We just didn't have it because nobody built it. So we're building it.
So you're kind of creating your own subclass.
We're creating our own market. Essentially, we're creating our own market. And generally speaking, in investing, you don't want to create your own market. But in this particular case, it really works well for us. We're creating our own market. And it's going to be really difficult for anyone to compete. Because if you are a property owner and you've had this property for 5-7 years, are you really going to go in and spend $10,000 per unit to upgrade this property? You know, if that wasn't part of your business plan, you would be giving up a whole lot of cash flow for all those years in order to be competitive with Ben and Sam, okay, in terms of quality of asset. So that answers the question. Now, it's difficult to do what we do because if we're right, we look brilliant and very smart. But if we're wrong, then we look like jokers. And there's no comps for it. So to have a lender understand what we're doing and to have a lender and a bunch of investors trust our market analysis, and it's difficult. It takes track record. It takes
relationships over a long, long period of time. But that's why we're seeing what we're seeing. It's between the occupancy issue and the lack of default issue is by and large because of two elements. Where are they going to go? This is Phoenix, and they already have the best product there is for what the money they can afford. And two, where are they going to go? We already gave them the best product they can afford. Where are they going to go? And that's also interesting, and I wrote on Bigger Pockets about it. You know, typically in recessions, you know, Class A gets hit, they start discounting. Class B tenants all of a sudden look around and say, well, shit, I can afford Class A because they're now $3 less expensive because they're trying to keep their occupancy up. And so Class B people leave and go to Class A. Well, Class B in response starts discounting, and Class C people look around and say, well, shit, I can afford Class B. And they pick up and they go to Class B. Well, in this particular recession, Class A is holding very strong for obvious reasons. Class B is very questionable. Class C is really questionable. However, when we've created the product that we've created, and our people get up and go looking at that Class B, and they realize that we gave them new countertops that are granite, and Class B that was built in 2003 doesn't have it, and we gave them new cabinets that are real wood, and Class B that was built in 2003 doesn't have that either. It's laminated countertops. So essentially, we've created such a compelling product that where are they going to go? That was the business plan, and that's what's playing out right now, essentially.
Okay. Does everyone understood that? Everyone's clear on that? Okay. Saw some blank faces there, so I wasn't sure if people were multitasking or not. But I want to go through some of these questions. I know there may be some people here that may disagree with what that approach. Obviously, you're doing something unique, and like you said, you're taking a lot of guts to do what you guys are doing.
Well, but that's interesting because I think it takes less guts to do this. I have the best product. Who do you think is safer in a deflationary environment? Someone who has the same thing that 100 other people have, or someone like me that has a unique product? All that I said is, I know that eventually will go down. So I want to be prepared. I want to have a unique product that nobody else has to keep my occupancy and to limit my concessions and to do all that. I mean, sometimes spending more money and creating a better asset is a safer strategy, even though it requires more capital. But, you know, nothing is what it seems in real estate. Just because you spent less doesn't mean you're any safer.
So Ben, what is the price point we're talking about where you can raise rents 400 and keep those people together?
They're not these people. We will buy units that rent in place for between $700 and $900. And when we're done, they're going to rent between $900 and $1,300.
So on the turn, you're going to 13, or you're bumping?
No, we're not bumping. You can't bump that much because the product isn't worth that much before we've done what we need to do. But so I bought the 100 units right here. I got my first 3 units. I'm going to renovate them, and then I'm going to bump it. Now, is it going to be more challenging in the beginning? Because I haven't built the office. I haven't built the gym. I haven't done the landscaping. I haven't fixed the pool, bought the equipment. I haven't done, it's not a complete package. So yes, in the beginning, it's going to be more challenging. But the way I look at this underwriting is when we look at a property, we ask ourselves, if we could sprinkle our magic dust right now, without rent growth, nothing. Right now, where the market is right now, if we could sprinkle our magic dust, snap our fingers, and this property is functioning perfectly like it should, what would the rents be? That's the rent I'm going after as soon as I get my first renovation.
And so are you looking for a certain amount of space in between what it's renting for today and your Class A product or your Class B product? Or how are you, since you don't have a comp, how are you picking what your target is?
Hang on a second. Shit. That's the art and the science. That's where you really got to know your market. So I look at this comp and Class A obviously identifies the top hurdle. And then you can't compete with that hurdle. Like, for instance, we bought a property 3 months ago that's in downtown Mesa, and it is being redeveloped like a mother. And they're spending God knows what kind of money on that. Well, these are going to be micro units in a lot of cases, 400 square foot units with built-in furnishings and things like that. Now, this is pre-COVID. I don't know what kind of impact COVID is going to have. I doubt it's going to have much of an impact in actuality, but these are going to be $2 a square foot rents, for instance, okay? So they're going to get, or $2, forget $2. That's going to be $3, $4. They're going to get their $1,700 of rent for that 500-600 square foot apartment. So we bought a property with nice big units, a lot of 2-bed, 2-baths, washer and dryer installs that we're doing, all of that. Our rents are going to be about, on the average, about $1,300. So you have this Class A for a much smaller, and a location is right here, right across the street. They've already put up the first one of these projects across the street, like literally a quarter-mile walk is what it takes to get from my property to this new construction. So a lot of people are afraid of new construction. Oh, it's a new construction. It's just going to destroy everything. I don't look at it that way. We see opportunity. We bought a property with average rents of $850. And when we're done, average rents are going to be about $1,250.
What are the Class A right there in that neighborhood?
Probably about $1,700 to $2,000.
And what about the regular Class B? They're the $850 that you started with?
No, they're probably going to be, that's the thing, is we're competing with the Class B, like the newer Class B, Class A minus, B plus. Average rent in Phoenix, according to the last data I saw, is $1,170.
But that.
So we're going to be right there. We're going to be a little bit more because we are in a trendy location for that particular project. And the units are extremely large. We're outfitting them with washer and dryer and the whole thing. So yes, they're going to be a little on the high side for the average. Let me check what the average is. I can open it up here.
Okay. Did we lose Sam? Is Sam?
Yeah, I think we probably did.
Sam's gone. Okay. I want to go back to we had some great questions.
$1,200 is what our average is going to be. $1,200.
Yeah.
So basically, average in Phoenix is $1,170. Average in the United States is over $1,400. These units next to Class A at $1,700 plus, they're going to rent for $1,200. They're going to be much larger. They're not going to be as well amenitized. So the proposition is not how do I compete with Class A. The proposition is how do I deliver 85% of the value of Class A for 60% of the price or 65% of the price. That's the proposition. And to answer the last question, yes, there's built-in LTL. So if I bought this property with average rents, I'll tell you right now what the average rents were. Ready? Average rents on Crest were 77. That's average schedule of rents. That's That's not the average rent roll. That's for the economic loss. The average schedule was right under $900. We're going to lift it to $1,200.
Are you seeing, I mean, you obviously, you mentioned at the beginning, you weren't seeing any real differences in terms of rent collections thus far. But, you know, I'm sure, and Ira spoke about this last week from Eastern Union, that primarily has to do with the fact that the government is currently assisting everyone. But what about, you know, 2, 3, 4 months from now, when that money runs out and maybe these people are still jobless? What are you seeing in terms of that?
So I don't have a crystal ball, so I don't know. So I can't tell you what is going to happen. I can just tell you how I look at it. People always say nowadays, oh, it's fake economy because people get this money from the government. It's fake economy. My answer is the numbers, the dollars are pretty real coming into our assets. So that's one perspective. Now, what's going to happen with, you know, when this runs out in an election year? How many of you think that we're not going to have another stimulus package? How many of you on this call are actually able to raise your hand and commit that there's not going to be another stimulus package? I think there will be. I think there will be, and it'll take us through the next 6 months. And then what happens? Well, I read a report that about, I guess it's 78% of the people that have lost their jobs are furloughed, not fired. Well, let's just say that some of those that were furloughed will become fired. So we've gone from 4% unemployment to 14% unemployment. We picked up 10% unemployment. Unemployment was never 4% because it depends on who you count. Unemployment now is not 14%. It depends on who you count and who you don't count. But, you know, proportionally, things are, we picked up 10% unemployment. So a lot of these people are going to come back and find work. Is it going to be 7%? Is it going to be 8%? Is it going to be 9%? How much of that furloughed personnel will come back to work? You know, it's, I don't know. All I'm saying is that whether it's 7 would be better than 9. But 9 is not something we can't cope with. 9 is not particularly healthy. It'll take us a year, you know, of slower growth maybe. But that's where it's important where you are. If you are in Phoenix, where even now tech companies are announcing setting up shop with 1,500 employees, like literally 3 days ago. I mean, I'm not that concerned. I'm not that.
Are you guys having any issues in terms of or employing anything in terms of health and safety in your properties, or you see that's gonna those if you are taking measures like that, that's just another thing to put into your underwriting?
Well, yeah. So no, I mean there's nothing. We're now starting to open in Arizona. We operated with closed office for about a month and a half. It had an impact. It had more impact with less repositioned properties for obvious reasons, because that tenant base still needs that contact. They still need that office. And when you close the office, you're making things more difficult. In more repositioned properties, we've seen very limited to no impact. But I don't know how you underwrite. Well, sure, you underwrite a little higher economic loss. You underwrite maybe no rent growth. But again, if you're starting at a place where we were growing rents by 8%, if everyone gets hit, then a municipality that was growing rents by 3% is going to see negative rent growth. But a municipality that was growing rents by 8% is likely still going to see 2-3% rent growth. So it all comes back to where you are and how much people want to be there and for what reason. I am in a growth market.
We got some more questions coming in over here. Let's see. I'm going to scroll up all the way back up to the top because we missed some. We're talking about now, COVID and multifamily, and I want to, jump into the networking room soon. But someone asked over here, how do you stress test your deals with financial models? What are the critical underwriting factors to watch for now differently than before?
I mean, we stress test in a lot of different ways. I don't know that we have time to go through them. Clearly, you stress test economic occupancy, you stress test your underwriting with assumptions of higher economic loss, lower LTV on refinance. If you have refinance, higher DSCR than required. I mean, you stress test a lot of different areas, and you underwrite conservatively. But I don't know if you've ever heard the saying that the best defense is offense. Mm-hmm. I am lifting rents by $300. If I am wrong by 50%, my value add is still better than majority of value adds out there. And that's it. I mean, it's all teed up by the deal you do. Like, people flaunt $100 of value add. That's not value add. That's not value add I'm ready to get out of bed for. It's not safe. Now, how do you underwrite differently now? It depends on if you think we're going to have any lasting effect in multifamily. And I don't know. I think we will have an effect. I think the prices are going up. I think cap rates are going to compress further. I think there's an absolute bloodbath in the office space, a bloodbath in the retail space. There's a lot of money chasing both. It can't do that anymore. It's unsafe. Where is it going to go to get its yield? Where's that family office with $100 million under management going to go to invest $5 million, to get some yield?
For sure.
So temporarily we have a disruption because there's a disconnect between buyers and sellers. But I don't think it's going to last long. I think multifamily is going to show itself as so much better performing in a tough environment than anything else. And if you think about it, what has been done? Nothing major. The government said, we will help you. The Fed said, we will help you. I want to be on their side. I want to be in an asset class that so many powers that be are invested in protecting. So will it take a little minute to shake out? Absolutely. Do I think that multifamily has somehow lost its luster? I think the opposite. I can't imagine looking at my performance, at the numbers over the last 2 months and this month, and going, no, I don't think I want to invest in this asset class. I don't see it. Now, will it change 4 months from now? Sure, there's going to be another bailout. Is that great for the country? Hell, I don't know, but it's going to be good for the tenants. So what happens after that goes away? Okay, so our vacancy bumps down a couple of basis points. I mean, as you look around and Rome is burning everywhere, it's difficult not to identify multifamily as a drastically more safe investment vehicle. And based upon that, So how is my underwriting any different? I just account for taking longer to do things. I account for maybe not having, I don't believe we're going to have zero rent growth in Phoenix, by the way, but I'll underwrite it. But I don't believe it, but I will go ahead and underwrite it, okay? So when we had 8% rent growth, I would underwrite 4% rent growth. When we are in this environment, I'll underwrite 0% for the first year. Do I think I'm going to have it? No. I bet you I go tomorrow and raise rents and people pay. Because where are they going to go? Now, a lot of that is me. It's the product we've created, right? It's the business plan. So is that fair to say for market as a whole? No, but no, I don't care about the market as a whole. I just care what our investments are doing.
Yeah. Okay. Well, I think that answered a lot of the questions we had, and obviously you gave your spiel, and that's really what you do best. So I appreciate you, Ben.
My pleasure to help.
Yeah. Well, guys, listen. I know the hour is getting late. I think we got to most of the questions here in the chat box. If you do have any more, I think one thing was someone asked about rent control or local government restrictions, if there's anything like that going on, but I don't think.
Yeah, so Arizona is by and large a very conservative state. So there's a reason Arizona was trading at 5 cap before this. And just incidentally, we have a property on market. And last month, coming right on the heels of this whole pandemic, people were making low offers. Those low offers were at 6 cap. That was low offers. Last week, it was already down to 5.5. I am not selling at 5.5. I'm not selling at 5. I'm keeping the property instead and refinancing it and doing something different with it if that's where it goes. But just to give you, just to underscore, there's a reason for that. This is a growth market. Cap rate is a reflection of investor sentiment. The safer investors feel in a market, the lower cap rate, the higher dollar per unit of revenue they will be spending. So then the real question is, why have people felt safer in Phoenix? And it's because of the job growth. It's because over there in California, they do A, but over here in Arizona, we do Z. And we're right next door, and we're benefiting from it. It's because the weather out here is nice, and because there's never any volcanoes blowing off or mud flowing, and therefore property insurance is low. There's also low property taxes in Arizona compared to many other municipalities, and there's laws on the books that make property taxes very predictable, so you know how to underwrite them, which is a real issue in many other municipalities. It's also the fact that, you can go to Indianapolis or Ohio and pay more rent for same quality unit that you will in Arizona. And we're growing like gangbusters, and they're not. And you have to ask yourself why. And so that's why long-term investors are bullish on Phoenix, and they're willing to deploy capital at very low cap rates. And even a shock like this, when the bottom feeders came out, they came out at 6 cap. That was like the dream for them come true. There's been zero activity because nobody's going to sell at that. There's no reason to. There's no distress.
Now, can any of this be translated into other markets, you think, or you think this is really unique to Phoenix? Obviously, you think it's unique to Phoenix because you're focused there.
I mean, I like Phoenix right now better than any other market in the country, including any market in Texas. I do. In Texas, the Texas is wonderful. It's got a lot of growth and everything. The challenge in Texas is the property taxes. Property taxes are very unpredictable and very high in Texas. And so the operating costs per unit are much higher in Texas. And therefore, I have to pay a higher cap in Texas than I do in Phoenix.
All right.
We like Phoenix.
Anyone else have any other questions for Ben on this subject or anything else? If not, we're gonna jump into the breakout rooms over here. Anyone who's on the Facebook Live, which we successfully did, and there's like probably like 10 people or so watching on Facebook, so that's cool. Thank you guys out there. There's a link to the Zoom room at the bottom of the Facebook chat if you want to jump in the breakout networking rooms, what we're about to do in a couple minutes. So jump on. Thank you very much, Ben. You're welcome to stay. You're welcome to go. Sam obviously took off pretty early. No pun intended, but he was, yeah, if anyone wants to reach out to Ben in the future, where's the best place they can find you?
Aside from Bigger Pockets, Ben at justaskbenwhy.com.
Does anyone ever ask you why?
A lot of people do. I have no answer for them. I just tell them, read between the lines.
Awesome. Okay,
hey,
guys.
So where's the link again to the?
You're here. You're on Zoom. But on the Facebook Live people, if they want to jump into this Zoom room, then they got to click the link so that they can come here, so that they can go into those breakout rooms. We can actually do a little, small group networking. And what I like to do on the networking, what we did last time, I think was a great idea. So what I'd like to do, we're going to break out into smaller rooms. Two things. Number one, when you meet the people, they may be people you've never met before. Obviously introduce yourself. And the first thing I want to do is everyone open another tab on your phone or your computer or whatever, and then connect to each other on LinkedIn or Facebook or whatever you want to do. Make sure that you don't lose that connection. So if you want to continue the conversation later on, it's a much easier way to do it than come and ask me later, who's that guy from Far Rockaway who had those glasses and a baby in his lap? What was his name? And I'm like, no, just connect with him on LinkedIn now, right? And so that you'll do, and then immediately just ask each other, really, I want you to do is just, what are you looking for right now? Obviously, this is a challenging time for everyone, but what are you looking for? And maybe each other can help one another through that. So we'll do the networking, the breakout rooms, probably 10 minutes or so, 10, 15 minutes in groups of 3, 4, and then we'll come back and do it again if that works. And people feel free to stay, to leave anytime you want. And without further ado, let's just jump into it.
Yona, thank you very much for the invite. It was a pleasure to be with you guys. I'm not sure how long I'll stay, or if I stay, but thank you.
Thank you, Yona.
Pleasure, Christine. Thanks, Ben. Again, so I'm just going to hit the networking breakout room button over here. You're going to see something on your screen. You click that, and you're going to go into a different room. So there's 30 people right now. I'm just going to do 10 rooms. Easiest thing, 3 in each. Popping off like flies. Okay, there we go.